All right, what is going on, everybody? It is Friday, the 11th of July. We are done with the week. It's the weekend. I haven't put anything out. Can't trade futures, so I'm a little bored, so I figured I'd go ahead and make an introduction to technical analysis and why it's important and how you use it to identify market regime, market bias, and how to structure your trade ideas based around what the macro and somewhat lower time frame sentiment is. So the biggest questions you would probably be asking is, what is technical analysis? Technical analysis is just a way you evaluate financial markets just by analyzing statistical trends, historical price charts. Some people rely heavily on patterns that play out. I don't necessarily use patterns that much. I'm more so watching trends and reversals on trends. And that's really all technical analysis is, like identifying trends and seeing how the price has been playing out. Because at the end of the day, this is a market. This chart is really just showing you, it's helping you visualize what is happening between buyers and sellers of an asset. And there's going to be trends. Supply and demand, it's a way to visualize supply and demand and that the balance between supply and demand. When there's a ton of demand and little supply, you're going to see that on the chart. You're going to see that as the price skyrocketing because there's an imbalance. And vice versa, when there's a ton of supply and not a lot of demand, you're also going to see that. Point being, technical analysis is just really just a way to learn to visualize supply and demand. So instead of looking at a company's fundamentals like earnings or revenue, technical analysis is more so focusing on patterns in price movement, and which i.e. supply and demand patterns in the supply and demand. Volume is also important too, like how many people are willing to enter this market and come forward as a buyer or a seller. And then there's other indicators, but that's like a basic idea. So there's a few basic things that you want to understand. You want to understand support and resistance first and foremost. If you're going to get into technical analysis, that's pretty much the most basic concept in technical analysis is support and resistance. So what I'm going to do is I'm just going to go on the chart and I'm going to mark out a few areas where we have support and resistance areas. All right, we got some there. We've got some here as well. We've got a key level right here. And this also is an interesting area around here, I would say. Yeah. This is just a zone right here. And I wouldn't necessarily say it's a support or resistance, but it's definitely a zone where there's some more to be looked into. And this is on the weekly chart, so this is getting into top-down analysis. So the thing about technical analysis is if you only rely on the lower time frames, i.e. the 1 minute to 15 minute, even sometimes the hourly to 4 hour, you can get caught up in a lot of noise. So the way that I operate is before each week starts, usually on Saturday or Sunday, I'm just giving you a window into what I would be doing as I'm analyzing these markets going into a new week. I generally start every week with the top-down analysis of the asset. Anyway, that being said, let me keep my train of thought here. So top-down analysis, right now we're on the weekly. We're just going to do a quick, Bitcoin's really hot right now. I know a lot of people are pretty exposed to Bitcoin, and I'm also interested in trading derivatives on Bitcoin, so I'm going to use Bitcoin as an example. So what I've done is I've marked out support and resistance levels. I'm also going to throw on a trend line. I would say this is a good weekly trend. Now, one problem that I see in the trading industry right now is people are very black and white about trend lines, and they want to see touch points. They're scared to draw it through price action. The thing is, a support and resistance level isn't set in stone necessarily. Like, price is going to sometimes coil around it, rotate around it, rather than just having really clean touches and either rejections or bounces. Sometimes you see this kind of like coiling action, and you can end up getting lost in this idea of a perfect trend that might look like this. You might put this on the chart, but when you're trying to trade this, it's going to give you bad risk reward setups, or it's really not if you knew how to draw a proper one, because this one's a lot better. But here you're going to be like looking at this and trying to set up risk reward ratios, and you're going to think that you don't have a lot of support historically down until somewhere around here if you didn't even know about supports and resistances. Instead of being so black and white, I tend to not be worried. And honestly, it's just more confluence that this trend is significant, because look at this. Instead of just bouncing, it's falling below this, but when it does, there's a lot of buyers that step in when it falls through, but then is able to reclaim this area. But in the same sense, when it breaks this area, there's a lot of pressure, but it is trying to get up back into this kind of fair value area. It's just, what it's signaling to me is there's going to be a lot of volatility, and volatility is good for me as an intraday trader. And see, like for an example right here, it falls and loses this kind of fair value trend, and as soon as it reclaims that trend, a ton of buyers step into the market, and there becomes an imbalance in demand and supply. So that's a great setup. Anyway, enough about that. So support and resistance really and truly is just going to be historically area. Like a resistance is going to be an area where there's a lot of people that are going to be willing to sell the asset, and that's going to show up on the chart as price trying to breach a certain level but be unable to. And that all that means is as soon as the price is getting to that point, sellers are beginning to overwhelm buyers. So that's the basics of what a resistance is. You need to understand what it is, not only how to put it on the chart. You need to understand, like, why is this something that I'm putting on the chart? So that's what a resistance is. A support is just an area where, as the price of the asset reaches that level, there becomes a balance in demand and supply. There becomes more demand than there is supply. So the sellers in the market are unable to overwhelm buyers in that area of the market. And the reason I do top down is it just gives me an idea of sentiment. So like over this span of time, which is from 2024 until now, which is July of 25, in general, there have been more buyers than sellers as far as Bitcoin is concerned. You can see that is what the trend is. The trend is just telling me that over time, day by day, there's more buyers than there are sellers. And that's why you need to understand that, because it helps you go into each day with more confidence in why you're taking a trade. So if I were to be taking a swing trade, I'd be very comfortable taking a swing trade long on Bitcoin. Am I going to go into drawdown at some point? Yeah, for sure. Maybe for the first few months of the position. On a weekly time frame, this is steadily going to the upside. So I'm not worried about that drawdown. And that's how you avoid getting shaken out of a position, is understanding a higher time frame sentiment. Because you can look at the chart like this, and let's say Bitcoin were to fall to 106,000. Someone that bought this, I wouldn't be a buyer here, but I'm sure there are because the price is going up. So people are buying here. If it were to fall and go into an area around 104, 105,000, some people might be screaming bloody murder, worried that Bitcoin's going to zero. But really, if you look at the chart, you see that that's pretty unlikely, because for at least a year it has respected this trend. And that is where you want to buy low and sell high, but you have to understand where to buy low, and that's at strong trends like this. And that's why I have the trend line as a thicker line, because it's a higher time frame, and I like to keep my chart easy to understand at any moment. When I drop down into a lower time frame, I will see that there's a thicker trend line here, and I'll know that's from a higher time frame, and that's why I do that. Yeah, I went on a rant about all that, but that's what you need to understand. It's one thing to know how to put it on a chart, but it's another thing to understand why it's there and how it affects how you enter a trade. If the information on the chart doesn't help you trade better, it's worthless. It's just noise. So that's a pretty good introduction to why you do a top-down analysis and why you start with higher time frames. It's really just more about building confidence for your trades. Now, if this were going to be something like more of an intraday trade, I'd be on the hourly. And obviously my sentiment is bullish looking at this. And then when you start to get better at technical analysis, I recommend just getting an idea of how to do it on higher time frames before you try and navigate Time frames below 4 hour. 4 hour even has some noise to it. I would say daily and weekly when you're just trying to get an idea of market structure. I would say stick to those time frames. Yeah, let me recenter and figure out where I need to go from here in this video. So I guess we'll just narrow this down. So we've established that there's weekly supports and resistances at these levels. And what I'm going to do is make these lines bigger so that I know when I'm just looking at them that they're more significant. Whoops. All right. And then let's drop into the hourly. Actually, you know what? I'm going to make this a two-parter. So this is part one. This is just going to be a higher time frame technical analysis and why you might use a higher time frame. To wrap it up, it's really to gauge sentiment long-term, maybe for long-term investing purposes, maybe for swing trading purposes, just to gauge where your entry might be historically the best as far as probability-wise. And swing trading, daily time frame is what I would recommend for swing trading. And the whole point is to understand historically where there are, if you're looking to go long, where there are more buyers in the market than there are sellers, and if you're looking to go short, where there is historically more sellers than buyers in the market. So that pretty much wraps up part one. That wraps up part one, and I will do a part two at some point this weekend. Yeah, exactly. All right, that's a little intro to something coming soon. We got another brain that's going to be popping in at some point, but yeah, part two coming soon. Bye.